I think the word a lot of people use to describe him is reserved, but he is so super reserved that I think one of the things I've realized from watching several of the conferences that he watched, that he's talked at, and again, it's rare that he will say something, and when he does, the markets just super react. But for the most part, he says a whole lot without really saying that much.
No, he doesn't say much at all, in my opinion. I think the guy stays so
Now, what I mean
neutral.
is he talks a lot.
He talks a
He,
lot,
he
yes. He talks a
speaks a
lot without
lot.
saying much, yeah.
He
But
says a
he's
lot of words, but he doesn't really say much. He doesn't really give any particular strong direction to
right.
where he's going.
He stays in that neutral zone so
Yes,
strongly,
yes, yes.
and in my opinion, timidly. It seems like he's a timid guy. Like he just does not want to put himself out there or put his opinion on
He
the
doesn't want to
line.
make any waves.
Doesn't want to make any waves. But isn't his job to kind of keep things moving, make us either feel confident or not confident? But at the end of the day, every time I hear this guy talk, when it's over, I know nothing about anything. It's like that was just a waste of my life right now. You know?
This the place where the info don't stop. Cash talks, yeah, you know it don't stop. Real talk, real keys, real goals on lock. From downtown dreams to the burbs of blocks. Turn a key, feel the beat, that's Cash Talks. Cash.
Real estate, rates, and real talk. Welcome to Cash Talks. We're going to get right into this. We got our infamous lender out of Glendale, California, back with us again tonight, Dave D'Souza. Hey, Dave, how are you, pal?
Good evening, my friend. Good to be with you.
Fantastic. Always love having you aboard, man. So, Dave, let's get into it real quick because a lot of people are wondering what happened with the FOMC meeting today, Federal Jerome Powell, and what he was going to say about rates, because a lot of us know or want to know what's going on with the mortgage rates out there and what he's going to do with the Fed fund rates that actually may have some effect with the mortgage rates, not necessarily, but he has an influence on it. What they do with that can have an influence on the mortgage rates eventually. Is that correct?
So yes, exactly. And then one of the things that I would piggyback on what you just said is, for the most part, and this is vintage Jerome Powell. And one could argue he may or may not have his reasons for this, but he says a lot of words. He speaks quite a bit, but a lot of people would agree that he doesn't really commit to too much.
Exactly.
And I could see where some people would certainly find that frustrating. On the other side of that coin, I would like to offer that because of the position he is and how heavily Wall Street and the markets and all of people that are related to the economy hang on his every word, he, more than most people, has to be very, very prudent, very careful about what he says. Now, I'm not necessarily excusing the fact that he seems to really not have much of an opinion about anything. And to your point, it's always data. Well, we need more data. We need more data. We need to keep our eyes on the data. We need to have more data. And sometimes it feels like that's pretty much been the story for the last 6 years, whatever it's been.
Yeah.
So that said, the effects of what he said on the market today didn't seem to have too much of an effect on either stocks or bonds, because essentially they left rates right where what everybody expected. They left them right where they were. They didn't raise them. They didn't drop them. And at the same time, he, like you said, didn't say much that moved too much. The one thing that he did say, and I saw an article, was somebody had brought up, one of the reporters brought up an idea of potential rate cuts, and he cut that off at the pass and said, right now we are not considering. This was one thing he didn't meander. He was very direct about this. We are not considering any preemptive rate cuts to, like an emergency rate cut because of the tariffs. At
Yeah.
least not at this point.
Yeah. And I honestly feel like he was talking back to Trump. Okay. Again, this is not a political thing here, but I feel because Trump, was saying Powell needs to lower the mortgage rates and the rates and the Fed fund rate, which will affect that, obviously. But he also said that he's behind the eight ball. He's late to the game. And to me, I feel Jerome Powell was just kind of like talking back to Trump through the media here, basically.
Well, and to your point, he has done this on more than one occasion. If we recall, in one of the more recent meetings within the last two, one of the reporters point blank asked him, can President Trump fire you? Can you be replaced? Can you be removed? And he looked straight at the camera and said no. And
I believe
I have a feeling
that's
when
the answer.
that was done, that he could very well have been speaking straight to Trump.
I believe that's the answer. I unless there was an executive order or something that changed that, I don't know. I don't know if there's something Trump could exercise to remove him. I mean, because what if the guy just started going completely crazy? What if he's like, woo,
You
woo,
talking
woo,
about Trump, or you talking about
woo?
no, you talking about Trump, or you
No,
talking about Powell?
I'm talking about Powell. What if Powell just
Okay,
started losing his mind? Right?
yeah, well, anything's possible. I will say this. Having been in this market for 32 and a half years and watching different, Janet Yellen, and before her, the Fed chair that was before her, I've seen a few different Fed chairs go. And I will say that given the circumstances that Powell is in right now, I personally don't think replacing him is a good move. And the reason I say that is because a lot of people on Wall Street, a lot of people in the markets, while they understand that they're not thrilled about what he's done, they also understand the levity and the delicacy with which the delicateness with which this whole balancing act he's doing has to be handled. And I don't know that this is something that they have another candidate that say, oh yeah, they could do a better job. I mean, with as an example, inflation was coming down. We had things moving in the right direction. Going into the beginning, early part of this year, January, going into February, we had a very strong economy. The stock market was literally tipping all-time highs. Inflation was on its way down, and right, wrong, or indifferent, after this early introduction, and I think I want to say it was like early April, about the whole thing to do. I think the introduction started in like mid to late February, and then it sort of peaked out around early April with the tariffs. That was a curveball that Powell did not see coming, and not to defend him, but to offer that, with everything moving in the right direction, and all of a sudden you have these tariffs that are absolutely going to drive prices up. Whether it's for the shorter term or the longer term, they are going to drive prices up. That's a curveball that nobody in his position would want.
Yeah. I got to tell you though, I think the guy, like I said, the guy really needs to come forward a little bit stronger. He's walking around like a guy carrying a glass box on ice skates with shaky legs. It's like he's afraid to say anything. I want to be very neutral and right in the middle. I want to offend
I think
anybody.
the word,
But
yeah, respectfully, I think a good word that I've used often is he's very non-committal.
yeah, oh yeah, completely, 100% non-committal. But keeping the Fed fund rate unchanged around 4.25 to 4.50 is what he's doing. Inflation and tariff concerns was part of his talk today, and he also said that he and his administration or his group are not going to feel forced to lower rates in a hurry. So again, that was just answering right back to what Trump was saying about he's behind. He needs to lower these now. He's already behind. So to me, that was just another smack in Trump's face. Like, I'm not going to right now. We're going to do it when we feel ready. And he said the inflationary rate is down to about that 2% number again, which has been his goal, but it still keeps bouncing just a little bit above it, hovering a little, the fluctuation. So I guess he wants to see a steady 1.9, and then he's
Well,
going to lower the
also part
rates.
of it is with had the tariffs not been introduced, I think his position would be different. And again, I'm not trying to defend him, but where we are is one thing, but where we may be heading is another. And rather than being reactive, where they're either raising or lowering interest rates after prices have gone up, after inflation's gone up, they're trying to do a balancing thing where he's looking at it saying, okay, fine, inflation is close to where we want it to be.
Mhm.
And I firmly believe that if tomorrow Trump was to come out and say, okay, we've reached a settlement with China, I'm rolling back all the tariffs, I guarantee you Powell's approach and his stance on rate cuts and the future of rates would be very different. Because right now he's not just targeting and playing for what is. He's targeting and playing for what could be coming. And he doesn't want to be in a position where, let's say, tariffs have caused prices to go skyrocketing, going up, up, and up, and up, and interest rates are low, well, then people are going to keep spending. So I think that's what he's trying to do. Again, not to defend him. He could certainly be, to your point, he could certainly be more committal about some of what he says. But there is some method to his madness. I would offer that.
Well, I think there's a big method to his madness, Dave, and that's the whole point. He's keeping it everybody available to blame something on other than himself. What he's doing. If
You're
anything
talking
goes
about
sideways,
Powell.
yeah, Powell, yes, Powell, yeah, exactly. It'll be Trump's fault. It'll be terrorist faults. It'll be everybody's fault. And then, even if Trump got rid of the tariffs right now, I guarantee you what Powell will come out and say. I need more data. We got to wait for more data. Give it another month for some more data. And then he can analyze the data. And he needs to feel very comfortable and confident about the data that he's reading. And then he might
You
make
think
some
even
sort
if
of
Trump would
decision.
have completely repealed the tariffs, we would find some other reason not to have rate cuts from the Fed?
I
Uh,
think so. Yep, I think so. So listen, here's what's happening out there in the real world, right? Is that there's people buying cars and leasing cars, and the interest rate is still, they have gotten better, but they're ridiculously high to where people can't even afford to get a car. Number one, forget the houses. Everyone goes, oh, you're a realtor. You want the rates to come down so people can buy houses. Of course I do. Right. But the interest rate affects everybody. How about credit cards, where a lot of people have had to rely on their credit cards because of their job losses or income deficiencies, right? And then they're going in and getting hit with 24 and 27% interest rates. They
no,
might as well.
just as a point, I saw on the news the other day of an alarming number of consumers are using credit cards to buy groceries.
Yes, yeah.
Groceries, okay?
There's a
I
real
mean, if
problem
you
going
think
on
about
out
that
there.
for a minute, you're using credit cards to buy
Yeah,
groceries?
yeah, yes. You want to know
That
why?
is a very,
Because
very dangerous situation.
yes, but guess what? Because they're buying houses because people still need to buy a house. They need somewhere to live. They want to take advantage of the American dream, even though the rates are as high as they are. We still have people buying homes. They're talking to lenders like yourself to figure out ways to buy rates down. Maybe we're getting the sellers to give us some credits back. We're working all angles to make this work for people, these high interest rates, which seem to be hovering around right now about what, 6.7 to 6.9 out there, Dave? I know you've got lower rates. I think you're around a 6.5.
Yeah, just as a matter of fact, as of a market update we did Friday, and if this is when you have a minute, I'll just give a quick recap of last week. But where we were Friday and where I am today is both in the same place. And that's right at where we've been for actually about 2 weeks now. And that's
6.5.
6.5 at par. And that's meaning for any borrower, a par price is a price where you are not spending discount points to buy down the interest rate.
Right. Okay. Gotcha.
And that right now, as of close of business today, which was the same as Friday, um, it might have been 6.6 on Monday, and then it's trickled back down to 6.5 today. It's being right at that 6.5 number for par pricing.
Okay. Perfect. Yeah. So, but around the rest of the country, you're looking at 6.7 to 6.9 is what it's down to there.
Yeah, typically most lenders are somewhat higher than we are.
Yeah. Yeah. Exactly. So besides the mortgage rates, okay, affecting housing and slowing that down, right? Which it has slowed it down. We're having a slow time right now because of these
Right,
rates. Right?
it's been affecting housing since mid 2022.
It has, yes. And then we get little fluctuations, and you and I both know when the rate was starting to get closer to 6%, it was getting busy. We were getting buyers coming back into the market. We had sellers getting on more offers on their home. Now, homes are still selling today, right? And there are still multiple offer situations, but there are homes that are just they've got a lot of attention on. They got a lot of attraction to that home, and they're also priced well. So this is not a market where sellers could just call the shots right now. Unless your house is just really over the top and again priced well, you're going to get action on it. But all that aside, you've got people struggling out there. The cars, credit card payments, as you were saying, buying groceries with credit cards and paying a 24 and a 27% interest rate. I think that should be just like, I think Trump had mentioned he was going to stop that and do a 10% cap on credit card rates. I think that's a
Well,
great idea.
yeah, and again, again, regardless of left or right support or partisan comment, I think it's very difficult for any president who is in the either executive or even judicial to have an effect on interest rates, because at the end of the day, what that's decided by is that's decided by the Federal Reserve, and then of course the banks adjust their rates accordingly. In other words, you've got mortgage rates at the low end and credit card rates at the high end. One thing also that is a little bit of a concern is that credit card defaults, auto payment defaults, even mortgage defaults to some exclusion, even though mortgage defaults are very, very low on the overall spectrum, many of those are at an increased level from what they were a year ago.
Right, right.
So, which means overall, there are more people sort of, I use the word carefully, struggling now than there might have been 6 or 12 months ago.
Yeah. Dave, let me share another little inside note for you. As me working in the field or the real estate market every day, talking to sellers and buyers out there, I talked to one recently, and this has not been just one case, but multiple cases where there are people, and as you know, those that are moving right now, selling their homes and moving and getting rid of those 2.5 to 3% interest rates, or not getting rid of it, letting them go to make that move is because they really need to move, whether it's work related, family related. But now there's another thing that's is changing the ball game. Is health related. People need to move because of something environmental. There's a change environmentally. It's having an effect on maybe somebody in the family or the entire family, and they need to move. But they're staying, risking their health concerns because of the interest rate. I've talked to people like this. I've had sellers call me and say they
You
want to
mean
move.
like
They need,
interest rate prisoners?
yes, right back to that. But really, it's not just because of the interest rate. It's because they don't want to have to pay the 7% or the 6.7 on the other side because they can't afford it. So they're
Well,
staying in a
as we
home.
said on podcast before, there's a lot of people that bought when rates were in the twos and threes that if they were to buy their house today, right now, they couldn't afford to buy their house right now today.
Exactly. That's the problem. So my point is there are people that need to move. Don't want to move, they need to move. Big game changer, right? But because the rates are just hovering around 7% and the cost of housing, maybe they bought that house 8, 10 years ago, and now they can stay in the house they're in. They got a 2.5 rate. The house they bought it, 8, 9, 10 years ago costs. And now they've got to look at buying a higher price home at a 7% interest rate. They can't afford to do it. Just can't. So the family is staying put and they're dealing with all the environmental elements that is causing and wreaking havoc on them right now. So, Jerome's got to look at some of these things. He, just controlling everybody with the interest rate and just putting everybody to this highest realm of costs on everything, from cars to groceries to credit card expenses and homes, right? And again, talking about the jobless numbers coming up now recently, he mentioned that a little bit. We said it was holding pretty steady, but I guess there's some more jobless claims coming along. But listen, every time you sell one house or buy one house, it increases the jobs in that community tremendously. I don't think there's anything that stimulates more jobs than that. So,
Let me share with you an example that is relatable about prices and interest rates. So at a certain point after COVID, rates dropped to the twos, 2.5, 3%. So arguably, with those lower rates, many people could afford more house because a lower rate but a higher loan still gives you the same payment. So what do you think was the effect of people being able to borrow literally almost indiscriminately at 2.5 to 3%? What effect do you think that had on home prices?
well, raise them.
Exactly. And what I'm getting at is while we would love to be able to lower interest rates to make homes more affordable and buying more affordable, exactly what happened in the home market is what the Fed may be worried about would happen in all the other markets. In other words, groceries, cars, whatever else we have that's out there. If they lower interest rates, because as an example, if somebody were to go out and buy a $40,000 car and they had to, to buy that $40,000 car, they were at a 7.9 or an 8% interest rate. That's a certain payment. And if all of a sudden the rate dropped to 2.5%, they would say, well, I could pay 45, I could pay 50. Because you take the higher loan amount and the lower interest rate still got the same payment. So typically lowering interest rates is something that has to be done very cautiously. Because if it's not done cautiously, then that will have a knee-jerk reaction of prices going up because the average consumer is going to look at it and say, well, I got a lower interest rate. I can pay a higher, with the same payment. That means I can buy more house. And that is exactly what happened in the housing market, which caused home prices to pretty much skyrocket when rates were in that 2.5 to 3. Just to finish my point, it didn't help that because of COVID, there was also reduced inventory.
Right. So, to your point, yes, he's got to be very careful on lowering the rates. It is an interesting balance, but also he has to be careful about raising the rates. There's a balance there as well. People still need to go forward and buy things, and they buy things on credit. right? Tremendous amount of people. There's a lot of cash buyers here, your Dave Ramsey type of trained people that, yes, they're going to pay everything cash, but even they use credit cards too at the end of the day. They may not let Dave Ramsey know about it, but they have a credit card somewhere they use every now and then. And it's nice to have it there in case of emergency. But when you got to use it in case of emergency, and you look, you got a 21 or a 24% interest rate on it, the emergency might happen. Actually, they look at things differently when they got to look at those kind of expenses. So I think there's a fine balance on that end as well, Dave, that has to be looked at too. So
You're absolutely right. I would offer that the probability that rates are going to stay the same or at some point go down is decidedly greater than the probability that they would go up. I think where Wall Street is right now, they're hoping for a cut, but they keep pricing in that it's going to stay the same. I think if at some point it got to a point where Wall Street was concerned that, oh, wow, he might actually raise rates, you're going to see very unpleasant things happen in the bond market and the stock market. I think right now the most likely possibility is that he's either going to leave them where they are, which is what they did today, or at some point lower them. I think that probability is considerably greater than the probability that he's going to raise them or they're going to raise them.
I don't think Jerome Powell even needs to show up to the next Fed meeting because it's probably going to be the same damn thing. He can just replay the last one, which sounded just like the one before that. So that's my thought.
You know what's interesting how you say that? If you were to play back the first 30 seconds, like he walks up to the mic at 11:30 my time, 2:30 Eastern. He walks up to the mic. The first 30 seconds of what he says is exactly identically the same every single time. It's literally like if you were to go back and look at the last 5 Fed meetings, the first 30 seconds are exactly identical. It's like he reads a script and then he says, and now I'll take your questions.
Dave, I got to ask you something. Who benefits from when interest rates go higher? For the mortgage companies, they're charging 7%, 6.7%. And the car dealerships charging more. Who's making that extra money when they're not able to charge or offer out 0% loans or 2.9 and those kind of numbers and really get things moving? And now they're charging 6 and 7% to buy or lease a car or to buy a home. Who's getting that extra money? Who's making that? Who's benefiting from that? That's
well, let me start by explaining this. Anytime a mortgage company or a car company or most entities make money, it's not the absolute interest rate. It's the spread between what they're lending it at and what they're borrowing it at. So if the Fed funds rate, the Federal Reserve raises interest rates,
right,
that means banks are making the same money because what's happening is the rate at which they're borrowing that money from the Fed is going up. So they raise the interest rate that they're charging. So it's a constantly moving target where their spread is the same. The bottom number being what they're paying for it, the top number being what they're getting paid for it by the consumer, and that the whole thing's just sort of moving up and down, if that makes any sense. Now, where it can be beneficial is ultimately what drives a lot of it in the long-term treasury notes are the yields. So the yields on bonds, so yields are going up, that means eventually the investors who hold those bonds are the ones that are benefiting. But when you talk about the Federal Reserve, the Fed funds rate going up, when banks raise and lower their interest rates, it's not that they raise their interest rates and they make more money. They're raising their interest rates because the rate at which they're borrowing it from the Fed has gone up. So in order to be able to maintain their profit margin, they have to raise or lower their interest rates based on how the Fed funds rate is moving, if that makes any sense.
Yeah, no, it completely does. Yeah, 100%. So,
I mean, as an example, if the Fed funds were to, when we were at COVID, what was the Fed funds rate down? It was close to 0. So that's why people were borrowing interest rate monies at like 2.5% to 3%, because there was about a 3% spread between what the banks were borrowing it at and what they were selling, or maybe a 2 to 3% spread between what they were borrowing at and what they were lending it at. That Fed fund rate, if what was at 0 has now gone up to 4.5%. It makes perfect sense that the lending rate's gone up to about 6.5% because all they're trying to do is maintain that 2% spread.
Right.
Which is where the banks make their money, if that's any sense.
I'll tell you, anybody out there listening, and you have questions about any of this, just reach out to us anytime. Happy to get do more of an explanation on this in any way we can to help you understand any of these discussions.
Cash, can I suggest something that is coming to my mind that I saw on TV, which maybe you could comment on?
What's that? Yeah, what?
There's a lot of these, we'll buy your home for cash as is, buyer's advantage and stuff like this popping up where they're trying to just go direct to the seller. And I've had a couple of clients that have had bad experiences with those. I don't know how you feel about presenting the fact that going with a realtor is a much safer option than just trying to be, taking a lower bid from someone like who's just going to come in and like a real estate venture capitalist who's going to like buyer's advantage, who's going to come in and pay you, 65, 70, 75, 80 cents on the dollar and says, yeah, we'll take your house, and but they're going to offer you a lot less than a realtor could get for you. I don't know if you want to talk about that, but I
Sure,
didn't see.
and that is a big thing going on. Like Zoodealio, that's what they do, and
One that I see a lot is buyer's advantage. It's these two guys, and they come on, and it's so corny. But anyway,
it is correct now. So yeah, what you're seeing is these real estate companies that come in, and they also want agents to buy into these programs too, where they could get leads to go to these people, and they come out with a couple different pitches. The first pitch is, we'll pay cash for your home, right? And you can do a fast close. You don't have to worry about
we don't ask any questions. We don't tell you any lies. We just take your keys for like 70% of what you could get.
Exactly. But then they need to set an appointment. They need to come see you. It's a great way to get in the door to see you. And it's a tremendous amount of people. Someone's probably going to chase me down and get mad at me for letting this out of the cat out of the bag on this, is that this is a way just to get in the door. And then they typically just list it at the normal.
You're saying this is just a gimmick and they don't really buy your house. They just end up coming to list your house anyway.
No, they will buy your house. And they have. People have gone for that. I think the ratio is somewhere around 4% out of the.
They're not paying you market for it. I guarantee you they're not paying market.
Oh, heck no. You got investors coming. These are investors coming to buy your house.
They're paying you what, 70, 75 cents on the dollar?
Pretty much, somewhere right around there. Maybe even 70, more like 65 or 70.
65, yeah. I was going to say, because, yeah, okay.
Yeah. So, yeah, and they get in the door, they meet them, and they say, listen, here's what we're going to do. Yeah, we make it very convenient for you. You don't have to put it on the market. You don't have to worry about all that. People seeing your home, worry about the negotiations. You want to chop, you want to move real fast on this, we'll pay you this, right? And then when they look at that number that they're going to pay them, minus all these fees, they actually have sales fees in there. They just don't call them commission. They call them other things. They have other terms for them, right? Just like when you go to Best Buy.
Basically, when it's done, the seller is basically just giving the house away. I'm not saying, I'm asking.
At a very discounted rate, yeah, they're definitely losing money on that, but they're paying for a convenience factor. So let's be honest, they are paying for the convenience of a faster move. They don't have to worry about showings and getting the house ready, and maybe sometimes fixing it up. Because when I go into a home that I may list, right, I'm going to share with them the things that they need to do to get ready for market. And there's always some things they need to do. Some houses look impeccable. They don't really have to do a lot, but maybe we have to do some things with the furniture and get it ready for showings, things of that nature. But they might have to do little things like painting and fixing some chips, maybe improving the curb appeal, things of that nature, getting the yard in great shape, fixing a couple broken pipes and leaks. Maybe the sprinklers are leaking. Maybe the roof is old. They're going to have to contend with that. So when they get these kind of companies come out, the advantage to them is they don't have to worry about all that stuff. Now, the company's still going to look at all those things to make sure the house is not in real bad shape. It's going to cost them a lot of money. They're going to factor all that in.
It's not falling off its foundation or something.
They're going to exactly. They're going to factor in a certain amount, but if it becomes too much, then they're going to, there's going to be a problem. They're going to have to renegotiate with you, right? But the point of this is to get in the door so they can meet you, and then you can pitch them for just doing a normal listing service for them. The challenge I have with that is the kind of agents that do that are the ones that you would probably rather have them just do the cash deal in your house, and you don't have to worry about service or class, and concern for your security and how things are going to go with showings, and respecting your time and being very courteous to you, right? Because they're very happy they've been blessed with the opportunity to work with you, and they want to make sure they're giving you the best service. So there's service-oriented people, and then there's those that just want to slam bam, let's do the deal. Like you're a DMV or something, right? Let's check out and get the money and go. So that works for some people, and maybe they need that in an emergency type of a situation. But most people want to capitalize on the sale of their house. I mean, that's
For
most
sure,
people's largest
for most
investment.
people, it's their main investment.
Exactly,
It's where all
100%.
their eggs are.
Okay. All right. So let's do a real rapid fire market update here, real quick. Santa Clarita, California, the inventory has doubled from this time last year. We're at about 731 active listings right now. And our absorption rate, which means how many we have going into escrow, right? Went from 44% last year, and now we're down to 30%. We just hit that 30% number, which means we're really in a very neutral market to maybe get into a buyer's market right now in Santa Clarita, okay? Somewhere around, I think we're at a 3.9 months supply of inventory, which puts us right at that neutral buyer's market that I'm talking about. Relatively close to the same thing in Las Vegas, Nevada. Buyer demand is still good. It has cooled off, and our inventory has definitely picked up there as well. Homes are on market longer. Days on market are a little bit longer before they're going pending. Values are holding strong to slight increases throughout the area, maybe somewhere around a 2% increase. And so it's very nominal, but kind of normal, 2 to 3% a year. That's kind of a very normal number. Yeah, more selection for buyers. Buyers are winning right now. Buyers have more selection, and there's not quite as many buyers jumping on the properties because the rates are still high all over for everybody. That doesn't change state to state or city to city. But anyways, and the Treasure Valley, Idaho, that area is probably holding the strongest right now, actually, because we still have people wanting to get up that way. Last year was really crazy. That was the number 7th growing state in the country, actually, the Idaho. And did I say the Idaho? I was going to say the Boise area. Idaho is the 7th fastest growing state in the country last year. Slowed down a little bit, cooling off again like everywhere else, but still it has some good, strong growth. Yeah, the crazy thing about Idaho is new construction is 40% of all the sales in Idaho. I've not even seen it like that anywhere. It's really something else. So there's still action going on in Idaho, and the prices and the values are holding their value as well. And new construction is still building there in Idaho. So anyways, I hope that helps give you a real quick market update for the area. So we're waiting on more market data to get to you. And in the meantime, if you want more cash in your life, just subscribe.